30 or 16 and a quarter. Soybeans were off 30 and a quarter, and winter wheat or hard red winter wheat was in there somewhere at 30 plus cents down or something like that. But um, rough day in the marketplace. You'd kind of talked about seeing a correction like this sometime here coming up, and then onward and upward from there, I guess. So, Sean, I guess as you look at what happened yesterday, your thoughts and reaction to what we saw.
Well, I think it's always important to look at the markets objectively versus the emotional, um, fantastical way that the media tends to portray markets. Let's take a look at what actually has happened. We had crashing markets before the end of June USD reports. The low in wheat, the low in corn, the low in soybeans were made that week. And then we had a bounce during a low volume holiday week. Always suspect, right? Always suspect. Um, and then we've had a retest. Yesterday's close, we still were at or above in soybeans on November. We were still at or above the prior lows in December wheat. And we made marginal new lows by a few pennies on December corn below what we hit the week of the report. So this is a full retest. This is actually what normally happens at bottoms. Sometimes it's a V, but that's a more rare pattern. Normally it's a bottom, you bounce, you retest the bottom, and and then there's the potential for um, some kind of more bullish pattern to develop. So we're retesting the lows. We've said all along this week was bearish weather. We might have to trade that early this week. The market excuse yesterday was that somehow they didn't, the models weren't showing that the track for Beryl was going to be as much into the eastern grain belt as it's supposedly turning out to be, and that more rainfall was now in the forecast than was there on Friday. There was rain there all along, good rain there all along. Is a little darker green, unless the reality is the rain was always there. So, but the market's free to trade as it wishes, and they decided they were going to take it back down and retest the lows from the lows that were set the week of the end of June USD reports. Um, and from what I see, nothing has changed about a hotter, drier pattern developing in the middle of the month, which is next week. And in fact, the way if you look at hurricane tropical activity, I live down here in Florida since 1999. I can tell you this is a fact of what happens when tropical systems come through. They they essentially suck everything out of the atmosphere, all the energy, all the moisture, everything. And after it passes by, what's left is extremely stagnant, hot, dry, and in many cases humid air where the rains fell a lot. And that pattern off at minimum, at least know down here, lasted 7 to 10 days, and oftentimes it actually changes the long-term upper airflow pattern. So um, the warmer, drier pattern that was always in place for next week is actually going to be hotter and drier now because of the storm being, let's say, more northerly set, meaning it's going to deprive the atmosphere of more of its energy than it would have been before. So while the market is focusing on its perception that more rain there than we saw on Friday's models means is bearish, it actually means a much more bullish pattern for next week and potentially going on into August. Already, NOAA has put out a level 3, 4 heat alerts over the weekend into Monday, starting on Friday for the Midwest of numerous temperatures in excess of 95 to 100 degrees. Heat index is very dangerous for especially older people. And that's a manifestation of what I just mentioned about what happens to the atmosphere. What I've learned is that the models always under forecast the heat, meaning the heat after a tropical system comes through tends to surprise to the upside, meaning it's hotter than the models thought it would be. And so uh, that's kind of where we're at. And if we got the COT, the Commitment of Traders report yesterday, because it was delayed because of the holiday on the 4th. And of course, this was as of last Tuesday, Casey. So soybeans and wheat were much higher last Tuesday than they were yesterday. So we don't know what happened yesterday. The corn market, obviously was also higher last Tuesday, but it was a little closer to where we are today. But nonetheless, we can still take a look at where were we last Tuesday before, let's say, yesterday's trade, and we can kind of discern some trends. The short position as a percentage of open interest in the corn market is the second highest on record, and it's almost a record of all time as of last Tuesday. Okay. Soybeans is the third highest short position by speculators as a percentage of open interest of all time. That was before yesterday. Wheat was the fifth highest short position as a percentage of open interest last Tuesday before yesterday. We can reasonably assume that we increased shorts yesterday as a percentage of open interest. We can argue how much, but I believe that it's very likely that yesterday we probably have made an all-time record in corn. We're probably top two in soybeans, and we're probably top three in wheat. And we'll know this, by the way, on Friday COT, because it comes out every Friday. As of tomorrow, or as of today, actually, we'll find out what actually happened. But that's my best guess. When you go back 45 years, really since the COT has been put out in this fashion, and you look at every single time that we've seen top five, top three, top two type of speculator short positions as a percentage of open interest, and you look at where the market was and where the market was 3 to 6 months later, almost, it is a high correlation to an important low in the market. Doesn't mean it has to bottom today. Doesn't mean it can't go lower tomorrow. Doesn't mean we don't lollygag here for a little while, for a month or two. These are longer term signals. In my view, though, farming is a longer term business. If you're a livestock producer, you're looking to procure cheap long term feed needs. You're not looking at the next 2 weeks. Speculator might be, but we're talking about people who have a serious interest in the long term health of their business. And so when I look at that, it's hard for me to be anything but constructive here, that we are putting in a major low in the grain markets. In fact, the last time that I recall seeing this kind of a setup in speculator positions, and this kind of a setup in sentiment, and this kind of a perception of fundamentals. Remember, when is the market going to make a low, Casey? It makes a low when we trade the highest perceptible supply we possibly can on the spreadsheets. Now, the spreadsheets don't mean it's actually going to be true. It's almost never true, but we trade it on the spreadsheets. Meaning right now, from what I can see, the market is trading a corn yield. We're just going to use corn, for example, a corn yield of, I believe they're trading right now with September corn at 390 something, a 185 to 190 yield. I believe that's what we're trading. And if you take the acreage report as it was stated, and you take the quarterly grain stocks as it was stated, we're trading a carry out between 2.7 and 2.9 million bushels for end of next year. Okay, that's end of next year we're talking about. I believe that is the largest supply number we're going to trade for the foreseeable future, meaning that perception, that spreadsheet perception that we're currently trading, I believe is the largest supply that we're going to trade for the foreseeable future. Meaning going forward, we're going to keep chipping away at that. By the time we get to July of next year, we're going to be nowhere near 2.7 to 2.9 billion bushels. But that's what we're trading today, and the market makes a low when it trades the maximum perceptible supply that we possibly can. I see so much in the media, and the media makes this distortion all the time, and it's worth mentioning, Casey. They talk about that that according to the USDA, that farmers were holding 3 billion bushels of corn as of the last reporting period, and that is the largest overhang since 1988. It's all over the place. That's all you hear, all left and right. But remember, it's supply and demand. So while the physical number, 3 billion bushels, is the same as 1988, we have a little more demand than we had back then. So if you take the supply divided by what the demand was in 1988, and you take that same supply and divide by what the demand is today, we're not even in the mesosphere of the same supply demand equations as we're 98. We're not even close. So you can't look at one side and say, well, it's the biggest. It's all relative to man. It's like saying, 50 years ago, um, I had 10 houses to sell and I had one buyer. Massive oversupply. Today I have 10 houses to sell and I have 50 buyers. Massive oversupply. No, it's not. Not relative to the demand for it, right? It's supply and demand. So why are we only talking about supply? Why don't we talk about supply and the demand for that product? And when you run the ratio, it's a joke. We're nowhere. We're not. It's not even remote. Anyone that says we're like 90, they're obviously wanting the market to go down. And so I think everyone needs to understand what the truth is, what the reality is, and what market psychology is, and why is everyone always bearish at the low? Why? Because they get caught up in all of these stories that 6 months from now, 9 months from now, 3 months from now, a year from now, prove to be incredibly off and false. And my job, your job, the producer's job, the end user's job is to be able to look out ahead and say, where's everybody making a mistake? How did everybody get the low in 2020 wrong? In fact, this reminds me so much of 2020 when we hit that initial low in July. We had a bounce. We made a secondary low in early August. Everybody was bearish. 275 corn puts was a winning trade by most of the grain market analysts at the time, I recall. How did everybody get it wrong? I mean, it's laughable what happened over the next 12 to 18 months. I mean, how could anyone have looked at the market forward and made such a terrible mistake on a consensus basis? I mean, that's an important question to ask. And remember, for every short that is sold, there is a buyer of that contract.
Right.
Everyone goes, all these big short. Yeah, but somebody had to buy all that.
Right.
And you know who's buying that? It's the Cargills, it's the ADMs, it's the Andersons Group, it's the commercials. Why are they buying all these contracts if we're going to 3.25, 350 corn? If that's where we're going, why wouldn't they just wait for the market to go down there and then buy it all? Because Cargill knows exactly how many acres we planted. They know exactly how much corn is out there. Right. They don't need the USDA to tell them what the truth is. I spoke at the Andersons Group a few months back. They know way more than the USDA could ever hope to know about what the truth is out in the country land. They don't wait for them. They know exactly what it is. So all they do is they take the ridiculous numbers coming up from the USDA and they take advantage of it. And that's their job. That's why we pay attention to what they do, because they have the ability to say, when is the market, there's a big miss here on the bearish story. They know what it is, and they're obviously, with their money, putting some historic long positions on in the marketplace because they think it's in their economic best interest to do so. They're long-term players. This is not a short-term, they're not short-termers. They're not looking to, get out next week, but looking out, the way they look at things, they feel this is an awfully, awfully good price. And sub $4 cash corn, the demand for corn is going to go through the roof over the next 12 months. The same mistake is made every single time we get here. Oh, the terrible demand, and everyone says terrible demand is going to stay for the next year. And they somehow don't realize that $3.90 cash corn is going to create more demand than $6.90 cash corn. Somehow they just don't understand this concept that the demand isn't going to be what it was when prices were higher. And of course, everyone's surprised when the demand is better and we didn't see it coming. And now, my gosh, the balance sheets are shrinking and things are getting tight. Nonetheless, that's where we are. And it sure looks to me, like this last takedown yesterday is a classic pattern that we see so many times, that completes and gets the last bull to finally jump off the ledge and say, I'm done. I can't handle this anymore. Yesterday was that day. I'm very, very certain of it, that whoever was left wanting to be bullish the corn market or the soybean market or the wheat market jumped off the ledge yesterday.
Gotcha. All right. Let's talk a little bit about the weather that you talked about the early. What you're talking about there, you had the hurricane hit Texas, and then the weather we saw go through there. Category 1 hurricane. Nothing in the term of hurricanes that's that bad, other than just a lot of rain, and a lot of wind damage. Saw that go through there. The crops in South Texas are wrecked. I've talked to a few guys down there and they've seen, they're right in the middle of corn harvest, so they have some issues there. Looking at the cotton issue situation that we see there, Sean, as you look at that situation there with the amount of water that's coming through that area right now, obviously bowls aren't open yet, so that's not going to be the issue. But I guess as you're looking at the cotton situation, did this hurricane help or hurt maybe some potential cotton yields?
If it had made more of a southerly track, like some of the models thought last week, it would have been done considerable more. It would have been more of a considerable issue, but it made a more of a northerly track, and it kind of stayed away from most of the core cotton areas. It did hit some core rice areas, but really the core rice area is Arkansas, and it didn't really catch eastern Arkansas really that much. So if you had to pick a spot for the least amount of impact to agriculture, the track it went on kind of was in between a lot of things, and it did least amount of it. So I don't really, in the market, cotton didn't move, and rice moved a little bit because there's some rice, there's a decent some decent amount of production there that was definitely impacted, but for the most part, pretty minimal agricultural impact compared to what it could have been had it been more of a southerly track, or if the storm had gone, more into the center of Texas. Instead, it just kind of, went like this, and it's just missing out on the key areas that would have been more impacted by a storm like that. Not to mention it weakened a lot, and by the time it got to Texas, it was more of a serious rain event versus a wind event. So,
yep. And the other thing you touched on too, which we talked about when we did our last live event, the heat coming here in mid to late June, or mid to late July. Here we are looking at the 9th of July, and this whole next week, this weekend and moving into next week, very, very extreme temperatures, extreme heat. Again, like you talked about, it's put out a lot of warnings for this week, especially about the extreme heat coming. Where I'm at, we're looking at 105 degrees pretty much through the weekend, starting on Thursday. And then there's no real relief in sight after that. Sean, as you take a look at that, when do you think the market will start making reactions to?
Well, let's be clear now. We missed the first half of July for corn. So, as we've stated, you can take the top off the yield, but we're not having a major crop problem is really virtually impossible now. But you can take the top off the crop. If we go from a 180, 190 yield expectation to a 180, 185 yield expectation, which is still a phenomenal crop, by the way, the difference in that perception is there's between a 390 market and a 450 market.
Right.
Significant. The farmer, would have a significant economic impact if we just go from what we're trading to a crop that's, even just 5 bushels an acre less, which certainly, in my opinion, high heat and a lot of dryness in many areas coming in the back half would be enough to at least knock production potential at least 5 bushels an acre off the top from what the current expectation is. It could be as much as 10 if we get a lot of warm nights in the east. I think there's a good opportunity potential for that to happen, but but nonetheless, taking the top off the crop from where we are today would allow for, in my opinion, the kind of short covering rally that producers could look to sell into. Remember, we always are looking to sell rallies into overhead resistance when our indicators are suggesting, that we should do so. We made that call in spring and made a great call to get some cash sales made, and we're going to be looking, but we refuse to sell into a hole. And we don't sell in a hole, and we're not going to sell in a hole because that's not the way we operate. We operate by selling rallies when our indicators are telling us to make cash sales when those rallies have occurred. We used the same approach back in late February, early March, the last time that we had darkness. Darth Vader was there with his lifesaver, ready to end life as we knew it. Many farmers panicked back then, and of course we had a significant rally in the market into the spring and had a great selling opportunity. If you have to sell, if you didn't sell the spring rally for some reason, well, if you have to do it, you have to do it. I mean, there's nothing you can do about it. If you have to sell, you have to sell. My point is, for those that don't have to sell, for those that haven't put themselves in a position to have to cash sell, be patient. I believe you're going to get a better opportunity to cash sell some more of your crop ahead, as time goes on here. Everything that I do, that I've been doing for over 30 years, all my indicators, whether it's smart money, capital flows, weather algorithm, supply demand, fundamental ratios, everything that I do says that this is not the time to be selling if you have an option not to.
Right. Okay. One last thing here. We have Chairman Powell is going to give his testimony today in front of Congress. Going to talk about what his plans are with interest rates and those kind of things. Everyone's anticipating that he's not going to do anything different than he's done already. He's kind of maintain the status quo. Sean, looking at that, what are your thoughts there, and what reaction would you expect to see out of this?
Usually the Fed chairman doesn't make any bold statements to Congress. He basically just repeats what he's already stated before. So this is usually not a market moving event. The market moving events can be when he speaks, or one of the Fed governors speak at a conference, a private conference. Then they can make some bold statements. I wouldn't expect them to say. I think they're going to toe the line. They're going to say what they've been saying. They're not going to really divert from what they've been saying higher for longer. Watching the data. Blah, 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 blah. I really wouldn't expect a major reaction or a major epiphany here. I would think it's more of, yeah, we've heard it before. Let's move on. I'm not anticipating, and historically we have not really seen them diverge from the playbook in front of Congress. They tend to play it close to the vest. So I don't think that's a big deal this week. I could be wrong, but the history says not to be concerned about anything majorly changing there.
Right on. Okay. Sean, good stuff as usual. Folks want to reach out to you and get more information about what you're doing over at Hackett Financial. What's the best way to do that?
Our Twitter page is at Faradex11. We have a LinkedIn page as well, Sean Hackett Advisors, and then we have our website, Hackett, Hackett advisors.com, where we from time to time post some of our work to see how we look at agriculture from an objective, long-term, statistical, cyclical approach is of value to those that listen and watch your show.
Right on. Sean, appreciate you being on the podcast. We'll catch you again hopefully Thursday this week.
Look forward to it, Casey. Thanks so much.
Right on. I'm Casey Seymour with Moving Iron Podcast. Check me out on Facebook, Twitter, and Instagram at Moving Iron LLC. Go to LinkedIn at Moving Iron Podcast. You can also go to the YouTube channel, which is over at the Moving Iron Podcast YouTube channel, and see the live version of that here. Also, go to movingironllc.com for everything Moving Iron related and get all the information for the Moving Iron Summit coming up here in Nashville, Tennessee, November 4th through the 6th. Sean will be there, and he'll be giving his synopsis of basically what the fourth quarter going into the first quarter of 2025 will take a look like. So we're looking forward to that, and going to see where that goes from there. Sean, also check out his stuff over there at his website. A lot of good stuff that you can see. And if you're not a subscriber to his newsletter, it's well worth your time to take a look at that. So to take that into consideration. So with that, I'm Casey Seymour with Sean Hackett. Let's go move some iron, folks. Out.